Okay, so good morning and welcome to our 12th weekly webinar. I'm Chris Newell, a partner in our restructuring team at Quantuma, and I'm delighted to be your chair today. As the country is slowly easing out of lockdown, we continue our series of webinars by sharing our insights with regard to what we're seeing in the current market. So during the webinar today, our experts look at how the construction sector has been impacted by coronavirus and what the future might look like as the sector gets to grips with a slowing economy. The question and answers function is open on this webinar, so please do feel free to submit your own questions in real time. Some of you have also submitted questions beforehand, and so we'll try our best to answer these at the end. So before we kick off, I'd just like to ask for your patience if we do experience any technical difficulties at all during the next hour or so. So without further ado, let me introduce the speakers for today. Firstly, I'd like to introduce you to Graham Randall. Graham is a partner in our restructuring and insolvency team and is head of the South West and South Wales region. Graham has over 30 years experience and his work includes debt restructuring, shareholder disputes, advising a more effective cash management, operational performance improvement, strategy planning, options analysis, managed exits, accelerated sales, orderly closures, and guiding the most distressed companies through an insolvency process. His sector experience includes hospitality and leisure, retail, as well as transport and logistics. So joining Graham today, we also have Ian Wright. Ian is a partner and licensed insolvency practitioner whose career in the business advisory sector commenced in 1991. He's previously spent 8 years with RBS, where he qualified as what is now referred to as a chartered banker whilst working in the law department. Ian's sector experience includes hospitality and leisure, construction and the construction supply chain, transport, engineering and manufacturing. So let's start the discussion. So Graham, if I may start with you, what are some of the short to medium term and then more longer term issues facing businesses within the construction industry?
Thanks, Chris. Morning, everybody. I think to start with, it's probably worth reminding ourselves that construction is typically more volatile than the overall economy, because that reduced economic activity results in less demand for new commercial or industrial facilities, and people's loss of income and lack of consumer confidence weakens demand for housing construction or refurbishment. And in many parts of the world, the construction sector was struggling before COVID-19, with jobs being shed and companies closing down. So in that context, the timing of the pandemic could not really have been worse. Firstly, the COVID impact has been significant. Following lockdown in the UK, construction output plummeted at a pretty rapid pace, with employment in the sector dropping at the sharpest rate since the financial crisis in 2008, and the steepest monthly fall in UK construction output recorded in the last 10 years. Now, following lockdown in the UK, a number of contractors obviously closed sites to review their operating procedures and to protect the health of their workers, particularly where it wasn't possible or safe for people to distance themselves from each other by 2 meters. Other home builders suspended all land buying, recruitment, and postponed all non-essential spend. As the lockdown has eased, workers in the sector have been encouraged to return to work, subject to pretty strict reviews of safety measures. And whilst the larger house builders have drawn up COVID-19 codes of conduct to minimise the risks to their workforces, some construction workers have complained of unsafe working conditions, and some have felt pressurised to return to site. In particular dispute was that 2 metre physical distancing rule, which some workers argued just wasn't possible to adhere to or enforce on crowded building sites and in work canteens. Now, there's clearly been significant disruption to supply chains and prolonged restrictions leading to labour and material shortages. Now, the closure of builders' merchants and manufacturing stoppages has led to a widespread shortage of materials, or it did at the beginning of the lockdown. About 3/4 of construction companies reported longer delivery times from suppliers, and they also highlighted, as we all know, a lack of safety equipment. So in the short to medium term, I think we can expect an increased focus on certainty of supply, including people identifying alternative suppliers and that's almost become a priority over the cost of materials. I think we'll see a wide divergence in responses to the pandemic, but companies that want to come out ahead of their competitors need to be thinking about this and taking action now. And I'd expect to see companies that have moved fast on improving productivity, reducing costs, reallocating resources. They would emerge in a better financial position with stronger balance sheets. Some of the smarter organisations, they're moving towards some remote ways of working. So designers and engineers are relying more heavily on digital collaboration tools. Some are using 4D and 5D simulation to replan projects and re-optimize schedules. So the industry has woken up and the trend towards digitization is being accelerated. Longer term, like it or not, a serious threat to the sector is a shortage of skilled workers, and the government really does need to get this back on the agenda. The sector's not really fully recovered from the skill shortages that were created by the financial crisis we mentioned in 2008, when a fairly aging workforce walked away en masse. That depleted the pool of skilled labour, and it's not really been properly replenished during the subsequent 12 years. So the vacuum of output created by the pandemic has the capacity to knock the sector back by another few years. Now, enticing people into the sector, which, dare I say, it has been perceived as quite outdated in its approach, has been a real challenge. A high percentage of workers are now aged over 45, so it's not really viewed as a young person's sector. So something needs to change in the education system to persuade young people to consider construction as a career. The perception that it's dirty, low-paid work, carried out in bad conditions, carried out in all weathers, and you don't need to go to university or college, that needs to change. And hopefully increased digitization will help towards that. Generally, I would say companies should be looking closely at their contract or their contracts. Are there force majeure clauses that alter their obligations when an event such as a pandemic occurs? Is COVID a force majeure event? Can you claim an extension of time to perform, or can you terminate the contract? Discuss those sorts of matters with your lawyers. And I think some of the major issues at stake longer term are looking at contracts. Do they need to be changed or extended? Can you apply for an extension of time? Is there likely to be consolidation within the sector to achieve economies of scale? Quite possibly. We saw projects after the 2008 crash were run at really crazy wafer-thin margins. Some companies we came across were literally carrying out work at no profit. So bigger and better, maybe more secure, and efficiencies and off-site construction. We could see more prefabrication work and an increase in that sort of thing as well, I think.
Okay, great. Thank you, Graham. Ian, if I can sort of turn to you now. One of the key issues for the construction industry will be managing working capital and supply chain impacts, which Graham's kind of alluded to. What measures can businesses take to deal with this?
Thanks, Chris, and good morning, everyone. Yeah, my view is that this is the fundamental thing that is going to drive confidence in the sector. I think margins, as Graham touched on, margins throughout the sector are so low that bad debts and badly run contracts can have a devastating effect. So if you look at from the bottom up, subcontractors, suppliers into subcontractors, materials, etc., all the way up through the main contractors need to have confidence that they're going to get paid. I think subcontractors in theory should have been paid everything that they did, for all the work they did pre-lockdown. It's more than 90 days past, so they should have been paid. If they haven't, that would suggest there's a bit of a problem. They need to understand their cash flow over the next 6 to 12 months. And in theory, if they've been paid for everything they did pre-lockdown and they've taken advantage of some of the government funding, you would think that their cash position is going to be as good as it's going to get. So they have to really understand what the cash flow is going to be over the next 6 to 12 months, as I said, and understand or make the decision about whether or not they're prepared to commit their own cash, or if they need to borrow any further money. If they're prepared to do that, and have they got confidence that they're going to get their money back in three months' time and onwards. I think that goes all the way through the supply chain. So it's got to drive confidence. I think that needs to come from the top. So the end user, the client, if you like, needs to show confidence to the main contractor that they're committed to the project, that the funding's in place, and they're going to see it through to the end. The main contractor then has to communicate that all the way down their supply chain, and then it flows all the way down. The one of the concerns, if you like, is that, well, can the main contractor do that with all their contracts? Have they got more than one contract? There's one bad contract in there that's going to cause a problem for everybody. But certainly communication is going to be key. The subcontractors need to be prepared to ask the hard questions, and the contractors need to ask the hard questions. And it may well be that if everybody communicates, that contracts have changed. Perhaps, I mean, the client doesn't want to proceed as was envisaged. Maybe they'd like to mothball it for a year or so and see how the market is. And maybe that would suit everybody. But people need to communicate all the way through, and only from there can they drive confidence in their ability to do the work, do it on time, and get paid for it.
Thanks, Ian. Graham, if I can come back to you, the reverse charge for VAT has been put back from the 1st of October this year to the 1st of March 2021 now. What are some of the issues surrounding this for the construction industry?
Well, I have to say I wasn't aware of the detail of this. I'd seen the headline, but I wasn't aware of the detail until very recently, and I wouldn't hold myself out as a tax or VAT expert. From what I've read, though, this is going to be a significant issue for the sector, and I've found very little guidance from HMRC about it. Essentially, the domestic reverse charge is a major change to the way VAT is collected in the building and construction sector. Its implementation, I think, was due to come in later this year, but has been pushed back to March 2021. But it means the customer receiving the service will have to pay the VAT due to HMRC instead of paying the supplier. The change is going to be significant and affect companies all over, and they're going to need to change their systems and processes and train staff. It will also create cash flow issues for suppliers. Now, that reverse charge, I think it was brought in to combat construction sector fraud, where suppliers don't account to HMRC for VAT that they've charged their customers. The new reverse charge means that instead of suppliers collecting cash from their customers in respect of VAT and being liable to pay the VAT to HMRC, customers will pay the net of VAT amount to the supplier and account for the VAT on their own VAT return. The VAT liability itself isn't changing, only the way it's accounted for. But the reverse charge is said to it will affect 150,000 businesses, and there's significant changes going to be made to IT and accounting systems, as I say, staff training, transitioning periods to the new arrangement, and undoubtedly there's going to be a negative impact on cash flow. And a recent survey worryingly found that 69% of SMEs weren't even aware that this pending reverse charge is coming in. And of those that were aware, only a third of those were ready to implement the new system. So my strong advice would be, if you're unsure what it's about, speak to your accountant, speak to your other professional advisors, check whether that reverse charge affects either your sales or purchases or both, and review your contracts with subcontractors to see if it applies under those agreements. Make sure your accounting systems and software are updated to deal with it. Consider whether the change will have an impact on your cash flow, and you need to start doing that pretty soon. Don't leave it till next February, because you might find it's too late and you've got a huge hole in your cash flow. And make sure all your staff who are responsible for VAT accounting are familiar with the reverse charge and how it will operate. As I say, a lot of companies are unaware of it. But if you take one thing away from this today, speak to your accountant about the reverse charge for VAT.
Yeah, thanks, Graham. I think that's good advice, and this is a big issue that's kind of coming sort of down the track sort of in this industry. We've got a few questions that are coming in. I'm going to sort of tackle them at the end, so do keep them coming in, guys. So thank you for those. Ian, if I can sort of turn to you again, construction is the second highest sector after retail that's taken loans from the government in the form of bounce backs and the business interruption loan scheme loans. So why do you think this is, and what are the risks on repayment of these loans?
I think, to be honest, I was slightly surprised by this. I think the initial criticism of the T-bills and the bounce back loans, etc., or particularly the early government proposals for funding, was that it wasn't easy to get, they were requiring personal guarantees, etc. And it seems to have gone the other way, and it's not maybe now too easy to get some of it. And construction, as you know, never known to look a gift horse in the mouth. So I suspect that it's been, well, there's an opportunity to get some funding now, so we'll take it now. We might need it in the future. I hope that's the case. In theory, most construction businesses shouldn't have had too many costs over the last few months. The furlough payment should have taken care of the biggest cost that they would have, and if they've been collecting the debts that should have been paid over the last 3 months, in theory, they should be sitting on a pile of cash. Whether that's the case or not, only time will tell. The concern, of course, is that a lot of these loans have been given to businesses that were already in trouble.
Yeah.
And if that's the case, they are certainly not going to come out the other end in any better condition. But I think there's a serious risk that there's going to be significant volumes of these loans are never repaid.
Yeah.
Yes, can I just add there? I think a possible reason is because it was one of the sectors that was most impacted by the pandemic, in that construction sites were considered unsafe working environments. A lot of them closed fairly early on. Therefore, until safety measures were introduced, a lot of projects did grind to a halt, and companies already operating on really, as Ian said, very thin margins with little or no cash reserves just took advantage of the government help on offer. How much thought they gave to when and how those loans would be repaid, I'm not too sure.
Yeah.
That remains to be seen. But if reports are to believe that up to 50-60% of these C-bills, bounce back loans, aren't going to be repaid, and those borrowers fall into insolvency, that's going to have an inevitable domino effect down the supply chain as the level of bad debt rises.
Yeah, that's right. I mean, the OBR's come out in the last few days, hasn't it, and said just that. And then some of the lenders have been recently saying that they're looking at some kind of student loan type repayment scheme where businesses can sort of pay back when they can afford it. So I think it's a big issue, and not just in the construction sector, but across all sectors, to be honest.
Yeah.
Okay. So Graham, sort of sticking with you for the moment, we're hearing that many subcontractors are concerned about going back onto site due to fears about non-payment. What steps can they take to mitigate this?
This is a really difficult dilemma for subcontractors, and they can easily be tempted to get back on site just to get some positivity back into the business, to send a positive sign to the workforce, get activity levels going again, and hope the cash starts rolling in again. For me, it will be about not allowing my position to worsen, not allowing my financial exposure to increase. So you should at least request payment of some of your existing debt for work that's already been carried out to be paid before you go back on site. And I'd fully appreciate that's easier said than done. If I'd done £100,000 of work and the debt was owed to me by the customer, and that was increasing by, say, £20,000 a month for ongoing work, I would want at least 20,000 of the old debt paid off first, with a fairly robust plan agreed for further instalments. If that can't be agreed, that's going to impact your own solvency position and could even put you in jeopardy. Now, for future payments to get agreement, you need to try and get agreement that you'll be paid on a more regular basis. That might be monthly, fortnightly, weekly even. The more frequently, the better. Because if you're paid weekly, obviously your maximum exposure or the amount you may have to write off in terms of the work you've carried out is never going to exceed another week.
Yeah.
If there is no agreement and you work for 2 to 3 months without getting paid, you're in a very uncomfortable place. But it's that question, do I pull out now or increase my exposure even more in the hope I'll get paid at some point in the future? You could try to renegotiate the terms of the contract to reflect what's happened and the impact of the pandemic. But it's all about communicating with your customer, with the main contractor, and sharing your concerns with them. If you're a valid supplier, you would hope that they would try to work with you.
Yeah. Okay, so communication is really key here, isn't it?
Yeah, I think so. And I think we're seeing a bit more, I'm not sure it's a sector that's particularly been known for its communication, but in terms of managing that supply chain, which Ian touched on just now, I think there's probably more collaboration than there has been in the past, which is a positive sign, but that needs to continue, really.
Yeah. Okay, so that collaboration and communication that's kind of happening at the moment, that this could be something good that comes out of it for the industry?
Absolutely, and collaboration, communication, speaking to each other, that's got to be a better way of resolving issues than just ending up in court, arbitration, mediation. All those things are time consuming, costly, and never or rarely end up in a good outcome. So collaboration and communication is hopefully the way forward.
Okay, yeah, I think that's really interesting that's happening at the moment. Okay, Ian, so what types of projects are most at risk of not being completed?
I guess it's the businesses that are going to be affected by not being able to have people in close proximity. So we've already seen recent high-profile failures of shopping centre owners, and you would think, well, who's going to want to build a new shopping centre at the moment? So, I mean, any ongoing projects in that area, you've got to think, well, is there a commitment to finish that? Are the funders prepared to fund it, or should it be mothballed for a period? Or what's the return going to be from the return on an investment like that isn't going to be anything like what was expected 6 months ago. Similarly, office space, I think we're all getting used to making calls like this. And is there a need for the same level of office space? Is there going to be a demand for it? Are rent levels going to drop? Having recently joined Quantuma and understand the levels of rent that get paid in the south of England, it's quite eye-watering, to be honest. So, yeah, will people be moving out of city centres and working more remotely? Hotels, I guess, are similarly going to be affected. But hotels and student accommodation, big demand over the last few years for them both. Hotels, the demand from tourists, etc., is significantly lower. If people are working more remotely and more used to working on video calls, will there be the same level of business travel? And students in universities for the last 3 or 4 months have been working remotely. Will that be a thing of the future, or will students continue to want to be on campus or near campus? So I think all of these are definitely going to be at risk, or certainly under close review at the moment.
Yeah, I think offices and what you mentioned about that, Ian, is quite interesting, and certainly kind of, us as a business and sort of lots of kind of our peers that we talk to, they're sort of saying that they don't need as much office space going forward sort of into the future. So I was wondering whether you're going to see over the next kind of few years, people kind of taking sort of less office space. But what that will mean is that there's kind of a lot of work to be done for fit out contractors sort of during this kind of period. What are the views, sort of Graham or Ian, sort of on that?
Interestingly, we've been engaged to wind up a fit out contractor in the last 3 weeks.
Yeah.
That had done some fairly high profile work down in the West Country, but their pipeline of work's just completely evaporated. Projects have been put on hold, similar to what we're doing as a firm. I know we were looking at taking on additional space in 3 or 4 locations. A lot of that's been put on hold for the time being, and that's affected their immediate ability to trade. I think larger organisations, I would agree, those employing many hundreds of people in city centres may decide to sublet space.
Yeah.
And that would provide short-term opportunities for the likes of fit-out companies over the next few years if the demand is there for that space. It'll largely come down to whether remote working continues post-COVID or whether we return to our city centre offices. So that it's that cost and travel savings versus the well-being of staff and slowing down on the impact of their development dilemma. If demand doesn't return, I can see some of that office space being repurposed into residential, student accommodation, that sort of thing. And again, that will create opportunities for fit-out companies and construction companies. So I think immediately there will be opportunities. Longer term, it's probably looking slightly different.
Okay. Good stuff. Keep the questions coming in. By the way, I've had a few. So one's just coming from Derek. So we'll kind of do that at the end. Right, Graham, what is likely to be the effect of the recently introduced Corporate Insolvency and Governance Act, or CIGA, as it's being called, on the construction industry?
I think one of the main factors is going to be the temporary lack of ability for creditors to present a winding up petition before the 1st of October this year, unless the creditor reasonably believes that the company's inability to pay the debts is not as a result of coronavirus. And I know there's probably quite a few lawyers on the call waiting eagerly for the 1st of October to come along. If those creditors do present a petition, the court will not make a winding up order until the creditor demonstrates that the pandemic is not the reason the company can't pay its debts. So unless these requirements are met, those companies are going to be protected from being wound up and from the obvious disruption that that petition would otherwise cause to its relationships with its suppliers and its customers and its inability to operate a bank account that's been frozen, etc., etc. Now, we would hope, again, coming back to that word collaboration, we would hope this would encourage more collaboration between customers and suppliers to prevent a raft of insolvencies in a few months' time. But my fear is that we may see a spike in winding up petitions once the legal protection period expires on the 30th of September.
So that would be the pent-up demand?
Yeah, it will be. That's the pent-up demand there will come through. We've also got the new role of a monitor, which is the other main area, whereby a company can apply to go into a moratorium for an initial 20-day period. That period can be extended in 20-day chunks up to a year. And that's where an IP is appointed as a monitor, but the directors of the company remain in charge. So the monitor must keep the company's affairs under review whilst that monitor continues to believe that the company is capable of being rescued. Now that monitor role or moratorium can be used as a freestanding process, or it can provide a gateway or a move into another insolvency process, such as a CVA or administration. But a key concept is that it provides a payment holiday on most pre-moratorium debts, and creditors can't take enforcement action whilst the moratorium is in place. It all sounds good in theory, but a monitor's actions can be challenged by creditors. The new provision could assist IPs in restructuring companies, and it will improve the chances of the cooperation of the key suppliers to the business. both restricting the termination of the supply and doing anything under the contract by reason of the insolvency. For example, making it a condition of supply that outstanding charges are paid, just as long as the company is able to pay for the supplies incurred from the date of the monitor's appointment.
Yeah, it's quite an onerous position because a monitor, it can only be an insolvency practitioner. So it's a fairly kind of onerous position for the IP to be in, isn't it?
It is in some respects, and for me, I would always apply this anyway with something like a CVA. I'd have to be really, really confident in management and what they're telling me and their financial, the figures that are coming through and their ability to deliver the outcome that's being promised to the creditors.
Yeah,
it can be quite an onerous role. We may see as a result suppliers inserting early triggers for termination in contracts as a result, just to preserve their ability to terminate the contract if the company showed initial signs of financial difficulties. But yeah, it's an interesting development, and I know that we as a firm have already looked at one or two potential cases where we are looking to take on the role of monitor.
Okay. We've just had a question come in from Gary, which is kind of related to this point. So if I can sort of stick with you, Graham, for the moment. So Gary said, sort of regarding the winding up petition point, are you aware of any examples of the courts allowing the petition to go through on the basis of the creditor's inability to repay its debt predating COVID?
I'm not aware of any of it. I'm aware of one or two where the petition has just simply been adjourned and adjourned on more than one occasion. Whether they're going to keep adjourning it till the 1st of October comes along, I'm not entirely sure.
I think I've seen one or two that's been allowed. So yeah, if it's kind of been put up to the court and that can be shown, I think the court have allowed a few to go through. So I think it's a yes on that, but the cases are kind of very few, and I think any judge kind of looking at it is going to be pretty kind of cautious given kind of what's happening. So I don't think you're going to see huge amounts of these kind of coming through.
Chris, but I just had one myself last week where a business was sold about 2 years ago, before I was appointed, and there was a lot of money outstanding to be paid. Subsequent to my appointment, the gym that had been sold went on fire, and there was an insurance. We were told there was an insurance claim being processed. I got to the point I got fed up waiting for information to basically prove that to me, and we put a petition in the court in Edinburgh last week, and not only did the sheriff consider it, but he actually appointed a provisional liquidator to secure the position for me. Clearly, we had to demonstrate it wasn't COVID related, which wasn't difficult, but I think highlighted our concerns about the information or lack of information we were being given by the company, and the sheriff was sympathetic to us on that.
Yeah, well, that's kind of good to hear, and I think kind of a 3-month window's kind of been given, hasn't it, for in a lot of kind of cases, but that's starting to kind of run down now, and people kind of are needing money, so they will take action sort of where it's appropriate to do so. So it's good to hear that a sensible decision was made then. So yeah, Gary, that was a good question, so thank you for that, and there's a few others that are coming in. Right, Ian, so what's happening with lenders? Are they pulling back from the market? What are you kind of seeing and hearing?
I think what we're seeing is at subcontractor level, there's very little, if any, appetite to give any funding. Where asset-based lending or primarily invoice discounting is available, if the services lend itself to that, I think there is an appetite, but a lot more cautious in their approach. I think that the key thing is funding of actual projects, and you would hope that banks and investors are looking at these on a case-by-case basis. Is there going to be there's going to be very few projects, I think, that started last year that are going to have the same return that was expected then, but is there going to be enough in it? Is there a commitment to it? And I guess you need a bit of a crystal ball as to how things are going to go. But I don't think, I think there's people still have money to invest and want to make money from it. So if confidence in a project is there, then the funding should be there. But I think all to be seen, wait and see.
Yeah.
I think if there's a second phase, it's going to just knock confidence so far that you know, we'll just, there might never be a recovery from that for certain projects, but hopefully that's avoided.
Yeah, just to add to that, sorry, Ian, I had a conversation with a QS this week. He does a lot of monitoring work for funders, just to monitor progress on developments. His view was that some high street banks will look at certain types of project in selected, this is safe sectors such as care homes or GP surgeries. Others are less active, especially on new customers, but they may support existing customers with a proven track record in the sector. Some secondary lenders, such as Aldermore, Shawbrook, Oak North, Paragon, they've got more of an appetite to fund new developments. But yeah, it's patchy at the moment, I'd say. Yeah,
no, that makes sense. Well, kind of on that point, sort of care homes that you've made in some specialist sectors within construction. We've had a question that's come in from Derek. And Derek's asking, will developers and construction have to become specialist sector focused, such as health and social care, where design and application are more complex? What's the view on that, chaps?
I think somebody needs to be a specialist. Maybe not everybody, but I mean, care homes are clearly, there's been a lot of risk there recently, and I think the design side of it is the bit that's going to have to really be considered very, very carefully. But the construction side of it, I don't see it necessarily changing much.
I can see that happening with some prefabrication. I mean, a lot of kind of hotels are built now prefabricated, and it's basically sort of like shipping containers and Lego, where they're kind of, you know, bolted together sort of on site, but everything's kind of plumbed in, sort of literally all the electricals, it's just all ready to go. So that kind of happens in the hotel sector, doesn't it, already? So you can see that kind of possibly being extended to care homes and so on. So yeah, possibly, yeah, that's the kind of way that the sector will go down.
Yeah.
We've got a question that's coming from Ian, so do keep the questions coming, guys. So Ian's saying, how do you feel that the new restrictions regarding the government revised working practices and resulting costs are going to impact the sector for both subcontractors and main contractors? Who's going to pay for the additional cost and delays, given contractors won't be as efficient?
I think that's a good question. I'm sure the cost is going to have to be absorbed by those in the supply chain incurring them, but some may question whether recommencing on site with revised procedures and PPE could jeopardise a contractor's claim for extension of time in the period when it was not on site. On the face of it, you might think arguably yes, on the basis that some may say if you're working now, you never needed to stop. However, the sensible and pragmatic view would appear to be that a contractor who stopped work, which may not have been safe, in order to carry out risk assessments and is now resuming with revised working practices and new procedures in place, yeah, is likely to be viewed favourably by the courts and the adjudicators in the future if a dispute was to arise. But I think in terms of the cost, I would have thought that's going to have to be absorbed through the supply chain.
Yeah, and that's going to be an issue, isn't it?
Yeah.
Okay. I've got another question that's come in from Catherine. So Catherine's asking, how do you see new startups within the construction industry? Are they going to be growing or shrinking in the future?
I think that there's definitely an opportunity if funded correctly. So, you know, if you're not undercapitalized and there's definitely an opportunity for new startups to catch a march against competitors who are possibly weighed down with bad contracts and bad debts and liquidity issues. So entering the market without proper funding and working capital is just going to be a disaster. But if I think there's an opportunity for new starts, there's also an opportunity for purchasing insolvent businesses and providing funding to them. Good businesses with good reputations and good practices who have run out of cash for whatever reason could be well placed if bought out of administration or whatever, with new funding in place, could do quite well, I think.
I'd agree. It comes down to demand and funding. Is the demand going to be there? If you listen to Boris and his build, build, build mantra, and there's a whole load of infrastructure projects, you can see over the next few years there could be a bit of a boom. Any company starting up, I'd agree, has got to make sure they're properly funded, and obtaining access to funding other than some sort of private equity, private funding. I think getting funding from the banks might continue to be a bit of a challenge, but the banks will support those well-managed, well-run businesses. Startups, it's going to be it'll be a challenging few years, I think, for anybody starting in the sector.
Yeah, I mean, that's kind of an interesting point about the kind of the infrastructure projects and sort of Boris saying sort of build, build, build. But yeah, if you go back to the budget, which is just before sort of coronavirus hit, and all those public infrastructure projects were announced, and I was kind of personally wondering where's the kind of manpower going to come from for these kind of projects, and that's something that you were saying sort of earlier, Graham, weren't you? That there needs to be a focus on kind of actually providing that.
Yeah, I think the government need to get it on the agenda, because it's a real concern, particularly with things like Brexit and some of the European workforce of sort of may not be around. It's definitely an aging workforce. The average age, as I think I said earlier, is somewhere 45 or above. Something needs to be done to attract the younger generation of wet, working outdoors, getting soaking wet in all weathers and that sort of thing. That has to change, really.
Yeah, but I mean, it remains a tough industry, doesn't it? It's kind of always there towards the top of the insolvency statistics for formal appointments, if not the top. So, I mean, do you think that's going to remain?
I think potentially that will always be the case. As I said earlier, it's one of the first. It is volatile, and that reduction in activity always leads to less demand for new, whether it's commercial, industrial, residential. The demand will drop off. So I think it's going to be difficult for that to change, really.
Okay. Thank you. Well, I'm gonna bring the session to a close, as that's pretty much time. So thank you to all those that have joined us. One thing that I would like to remind you all about is our recently launched interested parties database. What this is, it's an asset register to match people up to the right opportunities. So please do take a look at the details on our website, or get in touch with your usual Quantum contact to find out more. We hope that you found the webinar useful, and please do join us again next Friday at the same time for the next webinar in our series. Details are going to be available today. I'd just like to thank Ian and Graham for your time today and your knowledge, expertise and experience. So thank you very much. Have a good day, everybody, and stay safe.